Joining me right now is Morgan Stanley's Chief U.S. Equity Strategist and Chief Investment Officer, Mike Wilson. Mike, it's great to see you. Welcome back.
Good morning, Maria. Great to see you.
Mike, you are well known for this negative stance you've had on markets now. You're forecasting a downturn for the market, predicting the S&P 500 will drop more than 20% later this year. You've been warning of an earnings recession on the markets as well as on banking as well because of the banking turmoil that we've seen. Tell me how you would assess the earnings period so far. I know you're still bearish, but take a look at the earnings period, and then I want to get your take on explaining what's going on with this market. How come markets are up if things are so bad? You got the Nasdaq up 16% year to date.
That's right. Markets are only here to confuse us and torture us sometimes, and I feel like we're in one of those periods now. I mean, we're pretty definitive about we're still in a bear market. Okay, we think the rally since October, which we identified back in October, we thought we'd get a rally from 3,500 to 4,150. We got off the train in December, and we've basically been chopping around back and forth. And so I think there's this sort of view, hey, the index is up, we must be in a bull market. But if you look under the surface, we have one of the worst periods of breath we've ever seen. And so it's been very challenging for people to make money this year, even though the indices are up, because most stocks are not up. And so I think there's a little bit of an illusion going on there in terms of what's actually happening. As far as our overall call, it was a two-part call. We made we got bearish in the fall of 2021 on the idea the Fed was going to have to raise rates more than people expected. We called it the fire. And then we said, look, after that happens, there's going to be a slowdown in the economy and earnings. We called that the ice. And we're in the ice part now. So things are definitely slowing. I think most investors understand that. They appreciate that. And what they're trying to figure out is how much of that did we already discount last fall? Now, clearly at 3,500, we discount a lot more. At 4,200, we're not discounting much at all in terms of the earnings revisions we think are still in front of us. I mean, the first quarter of this year will be a full-blown earnings recession in terms of the way we think about it, which is year-over-year growth is now negative, 6, 7, 8%, depending on how the earnings come in. But it'll be negative for sure. And then I think the trick here, Maria, is that some people think, the earnings forecasts are now expecting a kind of a rebound into the second half of the year. So that, market's trying to get in front of that. And normally we would agree with that view. The problem is we don't believe those earnings estimates. We have much more pessimistic outlook for earnings in the second half of the year. So
let's talk about the earnings that we've seen so far, because I know that your expectation for the S&P 500 is in the low 3,000s, and we're at 4154 right now on the S&P. You're looking for the low 3,000s, and you're talking about tightening credit from the banks. You're talking about earnings revisions that need to happen. How would you characterize the first quarter earnings so far? And I know J.P. Morgan was, really set the high bar, but after J.P. Morgan.
Yeah, I mean, it's really early. So far, we basically have had the big banks and some other, companies kind of all over the place. We had some last night that's probably more indicative of kind of what we expect to see. And we've seen some pre-announcements here in the last couple of days that, to me, are a warning sign that the slowdown is getting more broad, particularly in the small, medium business area, which we think is that is the economy. So, look, the bottom line for us is we expect earnings revisions to continue to come down, probably for the next couple of quarters. At some point along the way, the market will figure this out and agree, if we're right, they will agree with our view that earnings are materially too high, not 5%, but more like 15% plus, and it will price it. We don't know what that event is exactly, what will cause that to happen. And we could be wrong about that. Maybe the market looks through and says, hey, we don't really care about this year's earnings. We're going to look forward to 24 and 25. We're a little more skeptical on that view, but that would be the bull case, is that the market, kind of priced it already, and we can chop around and you can pick stocks. You can always do that. You can always find things to own. Okay, but we do think that the path to our 3,900, year-end target is probably lower first.
So, Mike, what about commercial real estate? This is an issue that we've been talking about on the set for a long time. Mark Tepper and me are both worried about commercial real estate just by looking at office space and how so many people have changed the way they approach work. A lot of companies have had to, do new leases, releases on some of that office space. So is commercial real estate a problem that is about to break?
Yeah, and I want to, we got to define commercial real estate. There's a lot of different, pockets of that. It's really office and retail. And retail has been in a bad situation really since the GFC. But there are other parts of commercial real estate that look quite good, like multifamily. and warehouses and things like that. So you have to be more definitive. We think it's office. That's where the maturity wall is going to be a problem. We think over the next 2 or 3 years. That stuff will get financed. It'll just be at a much higher cost. But this also feeds into the regional banking situation, which we think ultimately, from our standpoint, is just a availability of capital. Right? You're going to get crowded out. They're going to have to refinance all this debt over the next couple of years. That basically crowds out other potential lending, and that's a negative impact for growth overall. So I think it won't end up in a big crisis. It's going to be more of a drag, another headwind for growth, effectively.
Yeah, and I know you focused on margins declining. We're just getting breaking news on AT&T, and AT&T has a revenue miss this morning. The stock is down 4.5% right now. That's why the Dow Industrials just took another leg down about 187. You also heard from American Express, which is also disappointing this morning. What do you think's going on in terms of the consumer? If you've got Amex talking about a shortfall, you've got AT&T coming in lower, sending the stock down 4.5%. Zero in on what the issue is.
Well, the issue is that we basically had, enjoyed a big windfall during the COVID lockdowns. We had a big stimulus. We overconsumed on a lot of different things. And now we're seeing consumers and small, medium businesses in particular start to retrench a bit. And that's how slowdowns happen. We overconsume, particularly in the goods side. We're still seeing quite a bit of strength in services, as you know, and that's very important for the economy. And that's keeping wages higher and things like that. So some of the economic variables look like we're okay from an economic standpoint, but the S&P 500 and the stock market in general is much more geared to consumer goods and consumption from both, small, medium businesses as well as consumers. So we think it's playing out in line with our forecast, essentially, that basically it's payback from, the overspending and over-earning that we had in 2020 and 21. And we'll get through this. But, the revisions have to come down, and I think people have just been too complacent around that.
So what do we do? I mean, is there anywhere to hide if, in fact, we do see this another leg down that you're talking about, another 20% sell-off? Are you worried about the dollar? The value of the dollar obviously down, but we've also got efforts from the CCP to undermine the global status, reserve status of the dollar. Are you worried about the dollar losing that reserve status? And number two, are there any areas to hide if, in fact, we do see that scenario take place?
Yeah, we're not worried about the U.S. dollar losing its reserve currency status. I mean, could it share some of that status over time? Yes, that's part of our multipolar kind of thesis, going forward, that, the dollar isn't going to be the only currency people care about. But the chance of the dollar losing its reserve currency in the near term is pretty low. De-dollarization is happening for sure. Quite frankly, that's helped the stock market in the last 6 months. The dollar's been weaker, and that's actually allowed some businesses to do better. So, a little weaker dollar is not such a bad thing in terms of keeping the economy going. I think your first question, look, for long-term asset owners, most of the listeners to this, you probably don't do much. Okay, we've already had the bulk of the decline in most of their portfolio. Bonds offer a good place to be. And then defensively oriented stocks or things that, equities, we still want to own them because we think inflation's here to stay, and equities are an inflation hedge over the long term. So for people who have balanced portfolios, you probably sit tight. What we would advise against, though, is adding more equity risk in here. And then for your trading type folks, we think there's probably a pretty big downdraft you can try and catch in the downside.
Mike, real quick, do you think the Fed is going to cut at some point this year?
Right now, we got to cut price in for the end of the year for the last meeting of the year, and it's very fluid right now.
Okay.
The Federal Reserve could be doing a lot of different things over the next 6 months, depending on how the economy goes.
Yeah, Mike, it's great to catch up with you. Thanks so much.